It's an extremely positive start across the Asia Pacific. The Japanese indices are up over 2%.
And the reason why the shares are probably up 8 to 12% is probably because of the preponed timeline for new launches this year.
The support for the Nifty comes in at the 22,340 level. Again, these are very close by. So, that's a 20-day moving average.
The other one I'm looking at is MOIL. Yesterday, the metal index took a bit of a breather, but MOIL was one of the big moving stocks in trade. And the volumes are the highest we have seen since November 2023. Delivery was the highest we've seen in the last three and a half months.
Coming to numbers, VNB has fallen 26% year-on-year to rupees 776 crore.
We are also seeing increased business from cable wire harness.
22,414. So like yesterday, right into that resistance zone.
The last 5 years has seen significant change in the earnings across the board.
Growth businesses, which now account for 30% of India, growing at 30%. That would be the guidance.
Well, for now, the market is looking very good. The Nifty is climbing by the minute.
The problem with ethylene oxide is if it's not treated properly, remnants of it can stay in the product, which is exactly what happened this time.
What highly placed sources within the government are telling us is that this should no point should be construed as access spectrum, which is traditionally auctioned.
Looking good for the markets today. We're still below that 22,500 mark, but a lot of individual parts which are moving around.
Well, that's the day so far. It's another good session overall for the market, I have to say that. We are coming to you live from the CNBC-TV18 News studios. This is Closing Bell. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good afternoon.
Hi, afternoon, guys, to both of you. Again, a screen that's looking similar to yesterday, where mid-caps are doing better off. The market breadth is good. And, of course, earnings reactions are getting, either rewarded or completely sort of clobbered, whichever way things go.
Absolutely. No room for misses, essentially.
Yeah, it's actually been good afternoons, right? I mean, a couple of afternoons, we are going into the last hour with the markets trading strong. Let's see whether or not we can drive home the advantage. The Nifty Bank will be the key factor to track because it plays out the weekly expiry.
Absolutely. And I think I think HDFC Bank, more than anything else, in a way holds the key, because even yesterday, the rest of the market was okay. The rest of the Nifty Bank was okay. It was only largely HDFC Bank which was contributing to that pressure. 13 or so on that one. Just a quick 3-4 points on the state of the market. So Nifty is now past all resistances. I mean, the 38, 50, 61.8, we are above that. These are Fibonacci retracements at a 1,000-point fall. And we are, as we speak, in this resistance zone, which is on your screen, 22,427 to 22,503. You take this out and then you're looking at the all-time high at 775. Broader markets, Bank Nifty, beg your pardon, just a quick word on that. That is also, by the way, above the 61.8% retracement. That was 48,111. Broader markets doing well, 0.6 to 0.8% gains across the board. And if you want to look at sectoral indices, metals have come back into some limelight action, and we'll talk more about that. And PSUs are really sort of doing well. So all kinds, really sector agnostic as far as PSUs are concerned, but that's a space which is in the limelight once again. Surabhi.
Oh, yeah, absolutely. PSU is doing well. The Bank Nifty is actually holding on to that gain of 0.5% as well. But a lot of individual stock reactions that are sort of responding to earnings one way or the other. The positive ones today include Cyient DLM, 6% up on that stock. Nippon Life just came out with numbers a while back, and the street is liking what they've seen. So 5.5% up on Nippon Life as well. On the flip side, you've got a Tata Elxsi that's still nursing those losses of about 4 to 5%. There's a 361, again, positive results, and the market's liking it. So it's all very, very event-driven and earnings-driven, triggers-driven, so to speak. But just to talk about some of the PSUs which are shining bright and standing tall today, HAL would be a case in point, NMDC, SAIL, there's MRPL, which is up about 9% right now. So basically, the PSU side of the market is thriving, as has been the case on most days, Nigel.
Well, that's right. And the metal stocks as well are firing away, and we'll get to quick analysis on that front. For the time being, let's find out how do you trade the final hour of trade. You have Mitesh Thakkar, who's with us. Well, Mitesh, good session, one would say. We're not able to take out the 22,500 odd mark. We're going very, very close to that. It seems we're in a bit of a band. How would you trade it closer to around 22,400?
Good afternoon. I think,
the major problem here is the non-ability to get past 22,500. The rest of the path, the rest of the situation is very, very positive. I think it's only the index, which is showing some signs of worry. My belief is that I think, overall, this is not a bad market, but since the index has got a resistance point which it's respecting, I think the idea should be to, avoid the index and look for opportunities elsewhere. The broader market in the breadth is definitely showing amazingly good traction. So in that sense, I think, that's a plus point. Having said that, I would also, want to recommend two metal stocks. I think you were just discussing the metal names. And I think, that's the sector which is buzzing very strongly. That could do well. And I have a buy on NMDC with a stop at 240 for targets of 260. And Hindalco is the other one which I would recommend buying. Keep a stop just below levels of 617, 616 here and look for a target of 660.
Okay, all right. Couple of metal stocks there, technically looking good. Thanks, Mitesh, for that. Well, let's welcome Prakash Diwan into the show. Hi, Prakash. Good afternoon. And good to see you. And Prakash, I wanted to get your view on the metal space. But for the time being, let me just take the viewers through why, in fact, the metal index is on fire today. Both ferrous as well as non-ferrous players, they are rallying. Let's address the tailwinds first for the non-ferrous players. The dollar index cooled off. The US and the UK, well, they have imposed restrictions on Russian metal trading on exchanges. Now we have copper, aluminium, zinc prices, all of them are at multi-month highs. As supply concerns persist, there's also potential higher demand that is expected from sectors across EVs as well as infrastructure. But what's working for ferrous names then? The Singapore May iron ore futures, they have jumped up to around $118 per ton. Earlier this month, it was sub $100 per ton. So that's one big factor. And the key reason for today's bounce is that the fourth largest iron ore miner, that's Fortescue, they have missed their guidance for the past quarter. They've also trimmed down on the outlook for annual shipments. Now, a key beneficiary to higher iron ore prices will be NMDC. While domestic ferrous players, well, they're better placed on rising iron ore prices. And let me explain this in further detail. Why are domestic players well placed when iron ore prices are moving up? SAIL and Tata Steel, they're backward integrated. So all their iron ore is coming from captive sources. JSPL as well as JSW Steel, they're partly integrated. Now, along with better availability, there's also iron ore pricing advantage here in India. Steel spreads could also get a bit of a booster shot. There are reports that suggest that steel price hikes are being pushed through. Coking coal cost, well, they're much lower than what we saw in the previous quarter on an average. That's quarter three, it was more than $300 per ton. Now it's hovering around $250 per ton. And expectations are that China's production will be limited. Exports will reduce in the second half of this calendar year, with the marginal improvement in demand that's expected in China, which will be positive for the steel sector on the whole. Well, the other stocks that are in focus include MOIL. There are expectations that price hikes could come about because global manganese ore prices have spiked up owing to that disruption in the Australian mine, while INFA as well is holding steady because chrome ore prices have moved up, which will support ferrochrome, and INFA is backward integrated with chrome ore. So that's a brief analysis on why ferrous, non-ferrous, and a couple of these plays, on the ore front, the mining front, all of them are doing well. Prakash, that's a brief analysis with regard to the metal stocks moving up. What do you make of it, though? They're moving on momentum. I was looking at the valuation chart, and that's why I've not really put it up, because they're trading at a premium in comparison to those valuations. So clearly the street is playing momentum. They believe there's a big metal cycle, bull cycle in store. Are you on board?
So, Nigel, I think you're right. The momentum stems more from a global perspective. Very clearly the genesis is more from the global commodity upcycle that's underway. And usually these cycles do last quite some time. Okay, so at least 2 quarters is what you need to give it before some sort of a normalization happens. The non-ferrous metals had already started showing that sign, and we discussed this when you brought up Nalco. We spoke about Hindalco and Vedanta being absolutely in the right spot. And they, I'm sure investors have got rewarded. Hindalco posted its last earnings call is actually moved up more than $120, which is in less than 3 months, right? So that's the kind of move that you have. But this round, if you really want to play with elevated valuations, I would believe you straight away go to the ore companies. NMDC, of course, has its own share of benefits and salience that's working in its favor. But my favorite has been Moil, and look at where it's touched today. It's made an all-time high of 407, right? I mean, it was sometime during the day. It's not maybe right now at that level, but given the fact that the kind of replacement cost that you could attribute to a business like this, which is almost like a monopoly, there's an ore that is going to be in demand given various usage, applications. I don't see any reason why you will not see the momentum continue. And remember, it hasn't participated, as much as some of the other well-known, well-discovered metal names are or derivative names are. So Moil has that, the rally has more legs, and from 300 zones, we've already seen 30% of an upside in the very short period of time. But I still feel it's got some more to go. So look at structural changes which are helping some of these companies. And I would believe steel would probably, be short-lived, but the non-ferrous metal names, the larger names, will probably continue doing well. And Moil particularly stands out with its own share of benefits as I expect.
Okay, so that's a view on metals that Prakash is taking. By the way, I just want to point out Equitas Small Finance Bank, it sold off about 2.5% after the numbers came in, and that's because of slight asset quality issues. The gross NPA has gone up quarter on quarter. And the absolute terms also, the NPA levels are higher. The gross NPA is now at 2.6% versus 2.5%. And in absolute terms, the number of, or the absolute sort of quantum of bad loans that's increased quarter on quarter is about 9.5%. And the street obviously is sort of not too happy with that. Otherwise, numbers were okay. But Prakash, hi, good afternoon. Talking about numbers, we've got some sharp reactions today. Tata Elxsi down, Tata Consumer down, Cyient, DLM, people have really liked. And then there's MCX as well. I mean, where at least a lot of those operating costs have come under control now that they've migrated to the TCS platform. But any of the interesting ones, you care to give us your views?
Good afternoon, Surbhi. So, very clearly, if you look at some of the disappointing numbers, and that's where the opportunity always arises. People had too much of an expectation penciled into Tata Consumer numbers. Tata Consumer has been doing all the right things in terms of expanding the product, white labeling so many of their own products. And given the kind of, expansion of the product portfolio, it is bound to have a phase where it's going to take a pause. It's not going to keep on growing at a scorching pace. But you also have to understand that this is a company that has transformed itself in the last couple of years, and the interview with the management very clearly tells you the new levers that they are working upon. And it might take some time, maybe a couple of quarters for that to happen, but it will probably get into a very high growth trajectory post those 2 quarters. And I think overall, if you see the consumption, the staples and the discretionary, the non-discretionary consumption pattern, it's still not picked up. Maybe post-monsoon, you'll probably see that, and a lot of spending that happens around the election campaigns will also start percolating down into spends in some of these product categories. But you'll have to give it some time. I don't think the HUL, the Tata Consumers, the Daburs of the world have yet woken up from that slumber that we've seen. But at some point, the sector rotation in the market, and this happens every time the market is at close to new highs, right? So people keep looking for newer themes, newer ideas, newer triggers, and that's when some of these will start kind of playing catch up very ferociously. So I would believe, the disappointment in the Tata Consumer numbers is a bit overdone. You'll probably see some sort of normalizing happening, and that's an opportunity for people who don't own it to add up into the portfolio.
Got that. Prakash, you want to listen into the next one as well, because this perhaps is also got implications for a resource company. Coal India is what I'm talking about. Now, sources tell CNBC Awaaz that the Coal Ministry's internal reports are raising demand concerns. Lakshman Roy is here with the details. Now, Lakshman, what we're talking about is demand offtake concerns for Coal India, not for coal itself, because, of course, we are still building out thermal power plants, but the offtake from Coal India, perhaps, in some of these internal assessments of Coal India coming under a bit of cloud. Take us through what you're picking up.
बिल्कुल आपने सही कहा, ये कोल की डिमांड कम नहीं होने जा रही है। दरअसल कोल इंडिया से कोल की डिमांड कम होगी। वैसा क्यों? क्योंकि कोल मिनिस्ट्री की इंटरनल असेसमेंट रिपोर्ट में ये बात सामने आया है। दरअसल इसके पीछे लॉजिक ये है कि अभी कोल इंडिया से जो टॉप 50 के बायर हैं पावर सेक्टर के, वो अभी 614.24 मिलियन टन कोयला लेते हैं कोल इंडिया से। इनके पास अपना कैप्टिव कोल ब्लॉक जो है वो 242.24 मिलियन टन का है। अगर नॉन पावर सेक्टर के टॉप 50 के बायर देखें जो कोल इंडिया के हैं, उनके पास अभी कोल इंडिया से वो लेते हैं 77.02 मिलियन टन कोयला, और इनके पास कैप्टिव कोल ब्लॉक है 44.48 बिलियन टन का। अब कोल मिनिस्ट्री का असेसमेंट ये कहता है कि ये जो कैप्टिव कोल ब्लॉक है, इनसे प्रोडक्शन 2 साल बाद शुरू हो जाएगा। जैसे ही प्रोडक्शन शुरू होगा, कोल इंडिया ये से अपना डिमांड कम कर देंगे, अपने कैप्टिव कोल ब्लॉक से कोयला लेना शुरू कर देंगे। तो 2 साल के बाद तुरंत इमीडिएट जो असर पड़ेगा वह है 20% तक कम से कम कोयले की डिमांड कम हो जाएगी कोल इंडिया से। लेकिन जब ये कैप्टिव कोल ब्लॉक से पूरे प्रोडक्शन के हिसाब से प्रोडक्शन करना शुरू कर देंगे, पूरे कैपेसिटी का, तब ये डिमांड घट करके 58% तक आ सकती है। क्योंकि टोटल अगर देखें तो टोटल ये लोग अभी खरीदते हैं 691.26 मिलियन टन। अगर दोनों को मिला दे तो इनके कैप्टिव कोल ब्लॉक को देख ले तो उनकी कैपेसिटी है 404.56 मिलियन टन, जिनका प्रोडक्शन अब अगले 2 साल में शुरू होने जा रहा है। तो ये एक कंसर्न है कोल मिनिस्ट्री का कि आने वाले दिनों में कोल इंडिया से कोयले की डिमांड कम होने जा रही है।
लक्ष्मण, लेकिन एक चीज आपने बोला 400 मिलियन टन है इनके पास जो कैप्टिव ब्लॉक्स हैं, लेकिन इनमें से काफी कुछ तो ऑलरेडी प्रोड्यूसिंग माइंस होंगी कि ये सारी की सारी अभी प्रोडक्शन में नहीं है और ये सब 2 साल में अब प्रोडक्शन शुरू करेंगी।
नहीं, ये बिल्कुल आपने सही कहा। दरअसल इसमें से कुछ एक माइन है जहां से प्रोडक्शन थोड़ा बहुत 10%, किसी में 20% का कैपेसिटी का प्रोडक्शन शुरू हो गया है। लेकिन इस प्रोडक्शन शुरू होने के बावजूद जो इनका डिमांड है, जो परचेज अभी बाय कर रहे हैं कोल इंडिया से, वो आपको दिया। प्रोडक्शन शुरू होने के बावजूद 691.26 मिलियन टन कोयला खरीदते हैं। लास्ट फाइनेंशियल ईयर का 31 मार्च गया है, उस फाइनेंशियल ईयर तक का डेटा कहता है। लेकिन जब ये फुल कैपेसिटी में आ जाएंगे तब इनकी डिमांड कम हो जाएगी। 20% से शुरुआत होगी, 58% तक, 58% तक जा सकती है। ये कोल इंडिया के असेसमेंट रिपोर्ट कहती है।
ये लक्ष्मण, एक क्वेश्चन बस और,
असेसमेंट रिपोर्ट
जी। सो लक्ष्मण, एक क्वेश्चन और, क्योंकि ये कंसर्न आया है कि आने वाले 2-3 साल के बाद जैसे कैप्टिव माइंस फुल कैपेसिटी पे जाएंगी, आपने बताया दैट द प्रोडक्शन कैन फॉल बाय एज मच एज 58%। तो अभी मिनिस्ट्री में कोई थॉट प्रोसेस है हाउ टू हेल्प आउट कोल इंडिया, कुछ इस तरह का एक्शन प्लान, इस तरह की कोई बात है, और इज इट टू अर्ली?
नहीं, इस पे बातचीत चल रही है। दरअसल इसको कैसे हम लोग इस प्रोडक्शन इतना ज्यादा कम हो जाएगा तो कैसे इसको दूर करेंगे। तो पहली बात कि इसके इंडिकेशन कोल मिनिस्ट्री को अभी मिलने शुरू हो गए हैं। कोल इंडिया से जो कोयले के ब्लॉक का ऑक्शन होता है उसका प्रीमियम देखें तो लास्ट टू सेकेंड लास्ट फाइनेंशियल ईयर में 252%, 252% हुआ करता था, जो लास्ट फाइनेंशियल ईयर में घट करके 72% हो गया है। मार्च में सिर्फ 43% आ गया। तो कोल मिनिस्ट्री को इंडिकेशन मिल गया है कि आने वाले दिनों में डिमांड कम होगी, कोल इंडिया को इतना ज्यादा प्रॉफिट नहीं होगा जितना की अपेक्षा रखते हैं कोल मिनिस्ट्री से कोल बेच करके। तो अब ये लोग एक ऑल्टरनेट रास्ता देख रहे हैं। ऑल्टरनेट रास्ता यह है कि कोल इंडिया सीधा कोयला ब्लॉक से कोल को ना बेचे, वहां से कोल गैसिफिकेशन में काफी ज्यादा इन्वॉल्व हो, कोल ब्लॉक में ही कोयला से गैस निकाला जाए, उस गैस को बेचे। उस गैस का बायर पेट्रोलियम कंपनियां जो पेट्रोकेमिकल कंपनियां काफी ज्यादा होती हैं। तो एक नए बार की तरफ अपने क्लाइंट को डाइवर्सिफाई करना पड़ेगा। इस पे एक रणनीति है जिस पे काम चल रहा है।
Thank you very much, Lakshman, for joining in and giving us all of those details. Well, Prakash, I wanted your word coming in on this. Coal India, people had concerns with regard to the ESG concerns. That got brushed aside. The stock from 150 went to around 450. In the near term, the big driver is going to be the premium of the e-auction sales to FSA. As of now, going by Lakshman's story, if in case that does take place and demand falls drastically, then obviously it's curtains down for Coal India. But the stock price is not really corrected. So the street is still factoring in that coal will still be in demand. What's your take at it on this 445, and how big a fear is it for Coal India shareholders?
So very, very interesting debate. This is going to trigger actually, Nigel, and I'm sure you'll have lots to speak on this in the days to come. Let's understand what he's talking about is not coal demand coming down. It is the contribution from Coal India to the overall demand in the nation that's going to be a shift, that's going to see a little bit of a shift. The reason why the Coal India stock does not get impacted or is not showing any negative reaction to this anticipated slowdown is it's still available at just about 2,75,000 crores market cap, which basis 12 months TTM kind of numbers is still less than 10 times P multiple. you don't have any energy stock which is into the primary energy source of this scale globally that would be available at such low valuations. So there's very clear valuation comfort. And what drives a stock price is more of earnings. If the profitability continues to be better and they become much more efficient with the kind of investment that they are making in the entire value chain, I don't see any reason why, the PE multiples would not expand, in fact. So on an absolute basis, there could be a drop in revenue. But as he said, the sliver and the joker in the pack, not just a sliver, is going to be the CBM, the coal-based methane projects that are likely to start seeing fruition. So, I don't see any reason why Coal India's contribution to certain other things won't grow while there's a let-up in the demand as a replacement from captive mines. Because it's more steel companies, cement companies which are looking at captive usage. Consumption of coal in power as a sector, I don't think is going to come down, given that we have huge targets, and renewables will have its own pace of contribution to make up for that shortfall. So gas will come in, wind and solar will come in, but coal does have its role to play. And as I said, there could be other things that could open up for them, and that's what the market will kind of definitely start visualizing. So I don't see any reason why Coal India, you should be disappointed with the performance. In fact, you'll continue seeing this rally forward and outperform the market, because growth rates are far more, the anticipated growth rates are far more. If you look at the con calls, you'll see what they're talking about. I don't see any disappointment from the stock price.
Yeah, absolutely. It's been at least 100% gain in just the last 12 months. 444 on Coal India today. It's been a dream move for this once unloved stock. Prakash, stay on. We'll have some more questions. Let's focus on the Nifty winner now. And Cipla is the one that's charging ahead, a gain of 3.5%. Investec has initiated coverage in the stock. They have a target of about 1550. The stock is at 1400 right now. So they're still expecting at least 10% upside. Let's go across to Ekta. Ekta, what is making Investec quite confident and bullish on Cipla?
Well, yes, top gainer on the Nifty this afternoon. Investec is bullish. They have initiated a long fast on Cipla. They believe that the 10% fall from the 52-week high is likely due to the anticipation of Amneal's entry into the drug albuterol, which is an inhaler drug in their portfolio, and a likely weak Q4 due to a muted India. Now, Amneal's entry could happen soon, according to the note, and Cipla's dependence, however, on the drug is low. So albuterol, for example, is around 7% of the FY24 EBITDA. The impact on the EPS is likely to be low, even with the entry of a new player. They see the possibility of upgrades for FY24 and 26. This is as Cipla delivers on key pipeline of drugs. So they have, for example, multiple peptides, Advair generic, a Brixon generic in their portfolio, US generics, macro, which continues to improve. When it comes to valuation, Cipla is trading at around 20 times FY26 estimated PE versus their sector coverage at 26 times and domestic branded focus names at around 32 times.
Okay, got that. Thanks very much, Ekta, for that. Prakash, Cipla, any interest?
Oh, absolutely. I think it's one of the top-notch companies in the pharma space. All the mistakes of the past have kind of got obliterated in terms of all the new launches that they've done so successfully, and the respiratory portfolio still holds sway over a very margin accretive segment. So I don't see any reason why there could be this. Of course, there's just corporate action which is still awaited. Some sort of an outcome is expected in terms of finding who is the likely suitor for Cipla. But apart from that, the general tailwinds that have been there, we've witnessed in the last 6 months for pharma, will continue to translate into very strong headwinds. Should be all the large companies, be it Lupin, be it Sun Pharma, Cipla, Reddy's, all of them are getting into a reset because of the strong balance sheets that they have. I think it's a cycle that's turning very favorable. Cipla, of course, is one of the well-run companies, but don't expect it to outperform the sector, because the company usually does not have any.
Okay, I think we lost the line there. Even as Prakash was talking. Prakash, we leave leave it there for now. If you can hear me, thank you very much for joining us. It's a pleasure having you and speaking with you as always. The market, I think, is up about 45 points, which means it's off the highs by quite a bit. 22,400, though, still holding on to. It's quiet, and this is a point that we've been making for the last couple of days, that maybe into this resistance zone. And just looking at the overall setup, I mean, US has been recovering, etc. But it's some of the other parts are not moving. Equities have moved up in the US last 2 days, 1% each. But generally, otherwise, it's been a bit quiet, at least in the index, that is. We take a break. We're back with Aditya Sood, Portfolio Manager at InCred PMS on the other side. Stay tuned.
Welcome back. Well, two of the big gainers actually yesterday are losing. Vodafone Ideas moved to the low point of the day. You have NBCC as well that slipped a little bit. So both of them are seeing some bit of selling pressure. Well, let's focus on Chennai Petro. That stock is rallying after posting a good set of quarter four numbers. Sonal joins us to give us a quick analysis. Sonal?
Well, yes, it is a good set posted by Chennai Petroleum. On a quarter-on-quarter basis, we have seen a revenue growth of 2%. The EBITDA has grown by 53%, and margins, they are higher by around 200 basis points to come in at 5.88%. Profits also accordingly have seen a surge of 72%. Now, this was something which was expected because Singapore GRMs, they improved on a quarter-on-quarter basis to come to levels of $7.9 per barrel. And even Chennai Petro's GRMs this time around have come in similar to those levels, $7.7 per barrel. This compares with the negative GRM number that the company had reported in the quarter gone by. Also remember, this is the surge coming in after a low base that these companies or standalone refiners saw in quarter 3. But if you look at the margins again, they are of course better than quarter 3, but still lower than quarter 2 levels, which saw exponentially high GRMs and margins as well. What the street also likes is the fact that the company has gone ahead and announced a dividend of 55 rupees per share, which means a dividend yield of 5.2%, and that's why the street is cheering these numbers. And MRPL also is doing well in trade on the back of good numbers coming in from Chennai Petro.
Okay, so thanks very much for that. I mean, there's no small moves for these names, right? Standalone refiners, go big or go home. That's the motto pretty much all the time around results or otherwise. And you got MRPL and CPCL both now big, sort of doing something really large as far as the price action goes. Our alpha manager is Aditya Sood, Portfolio Manager at InCred PMS. Aditya, good to have you with us here. Thanks very much for your time. I think in our conversation earlier, you had mentioned that you own Tejas Networks, and you kind of you said that you added onto that name. Stock's done very well. We had the management with us early on as well, talking about the business opportunity. How is it placed valuation-wise? Just talk us through your thought process. FY25 is going to be another very large year because of execution of the remainder of the BSNL contract. That should be worth about 7,000 crores. Just that order. FY24 revenues were about 2,400 crores. Your thoughts on this one, Aditya?
Sure. So, we have been fairly constructive on the prospects of, manufacturing as a theme. And obviously, Tejas benefits on two accounts. One is the PLI bit. Obviously, they get 6% PLI as a percentage of their overall incremental revenues. And we have seen PLI flowing through in the last quarter. When very notable fact is that, Tejas was under tremendous pressure for last 4 or 5 or multiple quarters on account of, elevated semiconductor cost, which is essentially a raw material for them. And we have seen that normalize in this quarter. As far as the ramp up is concerned, I think so it is a very well acknowledged fact by the street now that they have only executed 10% of what needs to be executed. More importantly, in terms of capability, and that is where the key lies. They have been a very successful fixed line company, telecom equipment manufacturer, but wireless is something that they are doing for the first time, and BSNL is a very large order. Now, if you look at the spec of their tender, 4G upgradable to 5G over a period of time, and what they have mentioned is that, essentially 40% of the 1 lakh towers that are targeting would be upgradable to 5G, and then there is an element of AMC cost as well. All that, with everything put together, I think so there is a long rope in terms of, the order backlog that they have. Order backlog has gone up 6x, ever since the Tatas have acquired the company. More importantly, this is about stepping up the wireless capability. I think so the stock will do reasonably well. It is a well acknowledged fact that possibly, you are looking at next 6 to 8 quarters execution to go through, and profitability is going to be in the range of cumulative profits could be as high as, 1,000 crores. That is what our estimate is.
Aditya, hi, good afternoon. Great to have you on today. I also recall from our last conversation, you were telling us that you're actually taking a favorable view on some of the FMCG names as well, some of the consumer names. And now we're running into the season. I mean, not to get stock specific, but obviously Tata Consumer flagged off some concerns because that's a little more discretionary, the beverage side of their portfolio. And there the numbers were not as good as what the street perhaps had in mind. But what are the expectations that you're going with? I believe you added HUL, if I remember correctly, maybe even Dabur, you have that in your portfolio?
Yeah, that's correct. One is that, we have got this belief that, if one has to buy, if one has to buy great companies, and typically, consumer has been a great story in India to be placed as a, investor. You have to buy them when there are headwinds, in the sense that, most of the multiple compression is behind you. A lot of the consumer categories, depending upon, whether we are focusing on or whether we are talking about, consumer staples or low unit consumption here. I think so. We have already seen 6 quarters of slowdown playing out at this juncture. Our view is that, possibly you will see some rebound in terms of volume growth. There are early signs of that playing out. There is some bit of respite with gold going up and with balance sheet repair, which is going to, obviously lead to, respite for the rural consumer particularly. Also, rural wages have, just normalized in the sense that they are back to the pre-COVID level. So our view is that, valuations are much more reasonable. Volume growth should do well. And any which ways, consumer is a defensive sector to be in. With, sector having massively underperformed for last 18 to 24 months, we believe that there is an opportunity to, allocate some money or to be overweight on low unit domestic consumption names.
Okay, all right. Hi, Aditya. Good afternoon and good to see you. When what else do you like? Consumption at the lower end has slowed down, but the upper end, it's everyone wants to consume a better brand, whether they are it's in terms of apparel, watches, liquor, whatever you refer to. How are you all playing this theme of the luxury segment doing much better?
Sure. So, we have exposure in, Arvind Fashion, which we have recently invested into. I think so. As you rightly mentioned, there are some categories wherein there is down trading happening, but at the same time, what we are witnessing is that, there is up trading which is happening as well. So we like Arvind Fashion in this space. I think so. They have got a very good franchise of brands. They have, sort of whatever mistakes that they have done in the past, in the sense that, they have, done away with unlimited which was obviously they were losing money. They have rationalized the brand portfolio. We believe that the return on invested capital can improve very sharply from here on. The valuations are very, very attractive. So we like, luxury consumption also as a play. The only thing is that, if we look at, companies like, for example, Landmark, what one has to be mindful is that, a lot of these luxury consumption businesses are cyclical. So the first point that we would have to figure out is that, whether we are at the top end of the cycle. And the answer really lies is that, whether you want to allocate as an investor for next 3 years or possibly next 5 to 7 years. I think so luxury has a long way to go. And, the way it has been demonstrated in certain categories, like including watches, for example, I think so the category has, legs to it. There is no doubt to it. And this is the first time, wherein we are experiencing larger luxury players, let's say Louis Vuitton or a Rolex, taking a market like India very, very seriously. And that gets reflected in the footprint that they have in India.
Since we're on the subject and you mentioned Arvind Fashions, I must ask you about the Aditya Birla Group's own moves on this front, right? Maybe they took a lesson from the Tata's books, seeing what happened to Trent, and now we have that business demerger, getting along. Any thoughts? I'm not asking for a stock recommendation, but just any thoughts on how this other business conglomerate is now looking to unlock more value? Do you think that can happen? And in terms of valuations, I mean, I don't know, was Trent a very unique phenomena, or do you think something like an Arvind Fashion or even an Aditya Birla, fashion retail, it can actually scale up in a similar way?
So if you look at Surbhi, essentially the evolution of West Side in this country, right? The key lies in, how much is full price sales for a retailer. So as a West Side consumer, you always felt that, possibly you never felt the need of having a discount if you walked into a West Side. And then there was a fast fashion learning as far as Zara is concerned. And this is what they have tried to implement in Zudio. And obviously, Zudio has been a huge success for the Aditya Birla Group, and that is why for Tata's essentially. So our view is that once you see full price sales going up in any format, and once you see right sizing of store footage area, that becomes a very, very powerful combination to consider in a retailer essentially. So as far as more focus on productive capital allocation is concerned, and what we are seeing in the case of Mudra, all those sort of moves are very, very welcome as far as the market is concerned, because essentially what we are trying to analyze as investors is that how many brands are scale and subscale. At the same time, we also want to see sharper focus in terms of return on capital employed. When large fashion house like Aditya Birla Fashion is allocating capital, because they will typically have multiple brands. So sharper focus is always welcome in terms of either the multiple re-rating or earnings growth potential.
Okay, all right. Aditya, we'll leave it there. Thank you very much for your time. Good speaking with you, and appreciate you joining us here on CNBC-TV18 today. Well, I think the market is down 25, is up about 25 points, which is it's a long way off from where it was early on. So it's been a slow kind of a descent, not a sharp one, but it's a slow but a sharp sort of fall from the high. Let me put it that way. 22,391 is where we are at right now, which basically means that we are almost back at the 61.8% retracement, which is 22,394. So you're right there. Let's see what the close is like. I mean, it doesn't matter 1 or 2 days, but the point is, we said this at the start of the week, slow, steady kind of a move after what we've had, especially last Friday, perhaps is the most desirable kind of a thing. So that's what we have to be.
I just wanted to add to that, Prashant, Coal India, by the way, I guess Lakshman putting out those concerns that are doing the rounds in the coal ministry.
Yeah.
The stock's cooled off. Yeah, there we go. So it's now up about 0.5%. The concern being that once a lot of these captive mines go on full stream, full throttle, will demand for coal from Coal India itself, whether that will go down or not. That was the story that he put out. So
we'll have to see how exactly these captive mines do ramp up.
Yeah.
Because some of these mines, they came up for auctioning around 6-7 years ago as well. there have been various phases of auctions as well in the past, and some of those auctions didn't get any bidders. So some of these companies, yes, that is a risk to them, because if they start producing from their captive coal mines, then obviously Coal India's demand goes down. The other factor is if there is more amount of renewable power that comes to the table, then that as well is another risk to Coal India. So for the time being, the stock is down 0.5%, as you said, or thereabouts. But if the worst fears come through, then the stock should be down far more. But at current valuations, I think it's getting some support.
And I guess since it's been such a big party for Coal India, I mean, sometimes you get news and inputs and then people decide to take some money off the table. So perhaps it's just a little bit of that that's playing out. Okay, let's quickly move on to D Street chatter. We have Nimesh joining in, as always, with all the insights from dealing rooms today. Nimesh, again, this is a session that's looking very similar to yesterday, because in the last 1 hour, the Nifty started cooling off while the mid-caps were doing better. What are you picking up today?
Well, again, looks like, Surbhi, there is a resistance on the Nifty around that 20 to 400 level mark. That happened yesterday as well, and that's playing out in today's market as well. So a bit of cool off after the gap up opening. But from a flow perspective, again, it's a strong day. There is buying interest largely now into the mid-cap stocks as well. The mid-caps are well bid from a flow perspective in today's market. I guess the big sector of the day is metals. Nigel explained a lot about the metal stocks buzzing in trade. But again, the key factor is that there is such a strong global manufacturing data which is coming out that's been seen positive for the metal names, and hence a big move in that stock. From a flow perspective, from a sector one, I guess pharma is a sector which is well bid in today's market. So a lot of pharma stocks are buzzing on cash-based buying from larger FIs. But from an overall market perspective, looks like 20 to 400 is acting as a very strong resistance.
Nimesh, what about individual names?
Well, so the first stock on my list today is Delivery. There was a large block in pre-open today. Nearly 2.5% equity got changed hands. So I understand the private equity investor was a seller and a couple of large FI investors bought in today's block deal. So the disclosures could be quite interesting in Delivery in today's market. So that's the first one. The second name is Graphite. That's been buzzing off late. It's actually cooled off intraday in today's market, but there are very strong buy flows. I understand a leading HNI investor is an active buyer as well in Graphite off late. So that's the second name. The third name is HDFC Life. That's been under pressure today, largely on big sell flows. So expect very high delivery volumes in HDFC Life in today's market. And the last is a couple of cash stocks, Titagar Rail and as well as Castrol. Both are seeing very strong delivery-based buying in today's market. So look like some bit of FI interest is back in cash stocks, and these two stand out in today's market purely on buying interest from larger FIs.
All right. Thanks very much, Nimesh, for that. You mentioned HDFC Life. Look at iPru Life as well, 3% lower on that one. And look at Max Financial Services. Max got an upgrade. I think there was an upgrade from CLSA, initiation from Ambit. Stock ended flat, and today it is down about 3% or so. So there is, of course, iPru, of course, reported numbers, and HDFC Life before that. We'll slip into a quick commercial break here. We have a announcement to share with all of you. Our upcoming live personal finance webinar, CNBC-TV18 Accelerate, will feature none other than the top market experts. Nilesh Shah, Managing Director of Kotak Mahindra AMC, and he'll answer all your questions on managing your finances. We'll also be conducting a special masterclass on what not to do with finances and the mistakes to avoid. CNBC-TV18's Accelerate Personal Finance Handbook with Sonia Shenoy will also feature 3 well-known experts, and we'll dive into everything you need to know to master your finances and learn how to grow your wealth. Don't miss the chance. Join us on the 11th of May, 9 a.m. And there are only limited seats. Scan the QR code on your screens to register.
Welcome back. You're with us on Closing Bell, and the market continues to cool off a little bit at the Nifty level. Just watching some stocks as of now. The cut on Tata Consumer is a little deeper, 5.5% gone from that stock. No sign of recovery. And then you have a couple of giants like TCS and Infosys from the large cap IT space and Reliance. So together, this trio is enough to put pressure on the market. Days low on TCS as well over there playing out. Okay, so that's the large cap space. Let's move on. We have some updates coming in on UBL as well. That's one stock that's moved higher after Heineken releases its update for the January to March quarter. So what is Heineken's first quarter calendar year 24 update saying? Let's ask Sudarshan. Sudarshan, so is beer consumption picking up in India? Is Heineken happy with how their India ops are doing?
I can't say that, but I can say that UBL is currently up 10%, and almost the entire gains have come since the time we have highlighted about Heineken's Q1 update. And in its update, Heineken says that India business beer volume growth has come in low teens. Now, it's important for UBL because UBL with its Q3 earnings had said it sees mid to high single-digit volume growth. So, Heineken's volume growth has come in higher than UBL's guidance that company had given for Q4. And just if you look at the last 3-quarter volume growth, in Q1 FY24, UBL's volume had fallen 12%. In Q2, it was up 7%. And in Q3, it was up 8%. So if it comes in low teens, it would be higher than the last 3 quarters that company has seen. And also Heineken says premium portfolio volume has growth in low 20s, and it was led by Kingfisher Ultra and Heineken Silver.
Okay, all right, got that. Thanks very much, Sudarshan. I wonder which of you 3 gentlemen have contributed. I know I haven't, but I don't know which of the other 3 gentlemen on TV with me today.
I think Sudarshan is smiling.
I think Sudarshan, he has the widest grin. I think Sudarshan's the man. He's downing the beers. I'll tell you one more data point. You know, today United Breweries' market capitalization has crossed 50,000 crores post this big move. So that's another highlight. But consumption.
Keeping a close eye on Ajal.
I mean, with
on all formats of consumption.
No, with this sort of heat.
You don't need any additional triggers. Okay, guys, let's bring it back home. Thanks, Sudarshan.
But by the way, beer's not hydrating. I mean, it dehydrates you.
Important to keep the science of it in mind as well. But let's quickly move on and go back to Mitesh for some final trades before the day closes over. Mitesh, you tell us, I don't know if UB is on your radar or not, but any other stocks that may look interesting?
I miss UB today, but what I've got or what I've suggested is Glenmark Pharma. I think that's closing in the day's high. So BTST here with a stop at 1,063 and a target of 1,090. And Gas Authority GAIL is looking good as well. So BTST here with a stop at 206. And we will look for a target of around 210.
Okay. Thanks very much, Mitesh, for that. Well, Axis Bank will be reporting numbers later today, post-market hours. Abhishek is here with what the key expectations are from this one. Abhishek, take it away.
Well, Prashant, Street is anticipating the slowest NII growth rate on a YOY basis in last 10 quarters. So the key things to watch is that sequentially analysts are expecting deposit growth to outpace loan growth. So deposit growth, as per analyst estimate, is at 6%, while loan growth is estimated at 4%. What could keep the net interest margin on the healthier side? The analysts are saying that loan growth will largely be led by high, yielding retail loans or the unsecured portion loans. Net interest margin can come under pressure. Morgan Stanley is estimating a 30 basis point decline YOY in net interest margin and about 9 basis point decline on a sequential basis. So slippages can rise on a sequential basis. Now Kotak Securities estimates slippages of 4,300 crore, Investec at 4,000 crore, which was about 3,715 crore in the previous quarter for Axis Bank. So slippages can rise, but asset quality will largely remain stable. Motilal Oswal expects gross NPA ratio and net NPA ratio to be flat on a sequential basis. Near-term growth outlook and the net interest margin progress will be the key thing to watch from the management commentary. Our polls suggest NII growth of 9% YOY and about 2.2% sequentially. We are working with a profit of 6,207 crores. This compares to a loss of 5,728 crore in the same quarter last year, and it will be up 2.2% on a sequential basis. Back to you.
Okay, all right, got that. Thanks very much, Abhishek. We'll watch out for those numbers. We'll be out after market hours. Mayuresh Joshi, Head of Equity Research at William O'Neill, is with us. Mayuresh, thank you for joining in. I want to talk to you about a large mid-cap stock, which was once the market darling, Tata Elxsi. We all know numbers today disappointed. But any sort of wider view on this? It's cooled off significantly. I was looking at the, 2-year highs. I mean, the stock was quoting above 10,000 at one point in time. It was a much-loved play in a lot of portfolios. But quite a lot seems to have changed since then. Your view?
Afternoon, Surbhi. No, you're absolutely right. I think from the peaks a few months back, it has corrected quite significantly. And the numbers that came in yesterday were soft. So there is no two ways about it. So the expectations of market participants in terms of recovery, specifically in the R&D space within the mid-cap IT companies, I think this is one hot space where a lot of analysts are of the belief that as mobility picks up quite significantly, and as the content per car starts going higher across geographies, companies like Tata Elxsi should probably benefit. But I think the numbers have been soft, and therefore the kind of reaction that you're probably seeing. The other end of the spectrum, Surbhi, its peer, KPIT Tech as an example, has done exceedingly well. Now, if you go by every passing quarter and the commentary thereof, numbers seem very, very encouraging. The kind of tie-ups that they've done, the order book that they're setting out of, the management confidence that they allude out of in terms of the margin performance itself, and expectations of maintaining this over the next few quarters is probably justifying the premium valuations and the move that KPIT and the outperformance thereof with Tata Elxsi as well. So to a certain extent, I think ER&D, the space, I think two spectrums that we're probably seeing. Tata Elxsi is clearly disappointing in terms of numbers expectations. KPIT is probably satisfying, at least till last quarter. How the numbers stack up is probably happening. So I think pick and choose, I think, at this juncture. But KPIT valuations on the higher side and momentum is a little bit too much for comfort.
Okay, all right. Hi, Mayuresh. Good afternoon. What about Aegis Logistics? Do you track that company? The stock is seeing a big move. I understand flows as well are quite strong. It's moved to the high point of the day. Any view out there?
Afternoon, Nigel. In fact, I'm just going through that in the morning itself, and both their divisions have done surprisingly well 9 months FY24. So their gas division and their liquid division have posted the highest EBITDA in the company's history. Again, the expansion plans, Nigel, that they're going through, specifically, I think the liquid storage, if I'm not mistaken, they'll come close to around 1.9, 1.95 million kiloliters, as well as the gas division, which they're probably expanding in both Pipavav and Mangalore, close to 125,000 metric tons. I think all these capacities, as they start coming on stream, and the expectations in terms of the sourcing that they also do, in terms of their gas requirements, the margin profile is expected to remain extremely stable. Now, with more capacities coming up and the incremental capacities, which will start adding to the overall volume growth in the next few quarters, I think that should drive strong, profitable growth as well across the divisions. So both liquids and gas should probably have that. And therefore, I think the entire perspective that one brings out in terms of EPS growth should be pretty solid. So yeah, I think the move is probably getting backed by numbers at this juncture.
Okay. Also waiting lever numbers. We should just pull up the poll graphics, the poll that Mangalam's drawn up for us, because we are expecting, again, sort of pretty flattish trends with respect to the expectations this time around, maybe sort of low single-digit growth in terms of volumes. That's lever, very choppy and flat right now. Do have to take a quick break. We'll come back and discuss, of course, the prospects for this stock and several others. We will be in our last leg on Closing Bell today. Well, here's a special programming note, and do keep this in mind. Our special Friday offering, Editors Roundtable, is now going to be coming to you at a new time. You can catch the biggest market headlines of the week with expert analysis from market veterans and, of course, our very own editors every Friday at 3:30 p.m. Don't forget to tune in. Welcome back. So I was talking about lever. The expectations are that there will be about a 2 to 3% volume growth. This is Mangalam's poll that he's put together. Mayuresh, very quickly, this sector has been left out in the doldrums for a long, long time. Do you see Q4 pointing towards any recovery? And what's your current weight on it? I mean, allocation weight to FMCG?
No, we are neutral, Surbhi, and I think the reasoning is pretty simple. Our belief is that numbers across the space, albeit one or two instances which might be outliers, will still be soft. A large part of the volume growth on the FMCG market comes from rural India. And rural India is clearly struggling at this juncture. You had seen deficient monsoons last year. The discretionary spending has come down. And therefore, a huge bulk in terms of rural discretionary spending will reflect in lower volumes. Now, is there a genuine recovery that one expects? Again, it's a twofold answer. One, I think in expectations of a normalized monsoon this time around, if that takes place, and fingers crossed it does, you will see a good sharp recovery happening in terms of rural incomes in the second half of this calendar year. And therefore, an earnest recovery from Q2, Q3 onwards for a whole host of FMCG companies. The other aspect, obviously, is that volumes have also remained tepid in terms of either increased grammage that these companies have done. And in spite of input cost increases, which have now stabilized to a certain extent, the pass-through was not very, very evident. So both volume and value is something which will be lagging in most FMCG companies. Valuations are sky high. Again, it's a defensive sector when market becomes volatile. But our take is Q1 onwards, I think you will see some element of positive commentary leading to a better re-rating in the second half.
Okay, Mayuresh, talking about FMCG, lever should be reporting anytime now, right? Mangalam is here for a last quick preview, key expectations. Mangalam, over to you.
That's correct, so I'm at the Unilever office. Results should be out anytime the next 15 to 20 minutes or so as the management preps to address the media. A couple of things that the street is working with this time around. Most importantly, not much has changed in the macro situation right now. Rural is still slower than urban, and at the same time, the companies are taking price cuts to propel volume growth. So net volume growth and price cuts will offset each other, resulting in flattish sort of revenue growth itself. For Unilever in particular, the street is working with 2 to 3% volume growth, minus 2% price cuts that the company is given, 150 to 200 basis points gross margin improvement because of benign raw material environment. But importantly, higher ad spends for Unilever along with, royalty and expiration of the deal that they had with GSK will impact their EBITDA. So net, we're expecting a flattish sort of revenue performance, 14,850 crores on the top line, EBITDA down by about 1%, 3,400. And we're looking at margins at around 23% with the net profit down about 4.5%. Importantly, apart from the quantitative numbers that the company reports this time around, one will be looking at management commentary on demand going forward, especially because, we're speaking ahead of general elections. Normal monsoon is the prediction. So is there any improvement expected in the very near future is something that the street will be looking at, largely because the stock has been an underperformer. Over the last 4 years or so, it has given virtually nil returns and is trading at around 46 times. So is not at a big premium to its historical valuations as well.
Okay, all right, Mangalam, thanks a lot for that. Well, I think we have Mayuresh still with us. Mayuresh, very quickly, if you could tell us about the cement pack. We have Dalmia Bharat that will be reporting its set of numbers, post-market hours. The numbers ain't expected to be good, and the intraday drop is telling you that as well. How do you expect the stock to perform?
I think we'll have to wait and watch for numbers, Nigel, to be very honest. And the expectation largely for the industry as a whole is utilization levels expected to pick up in the coming few quarters. A large element in terms of input costs have largely stabilized at this juncture. You have sporadically heard of some price hikes that have been taken in some key regions. And therefore, the expectations of an improvement in terms of the reported EBITDA per ton across the space is something that is to be watched out for. Obviously, the stocks that we have got on our watch list within the Adani pack, ACC is something that we believe can report a decent set of numbers. And JK Cement within the mid-cap cement space, where the white cement realization should be better off. Numbers have been extremely good so far in terms of both margin performance and an absolute EBITDA. And that performance should continue. So I think we're being a little bit more choosy here, Nigel. ACC from the large cap, mid-cap space, JK Cement.
Okay, all right, Mayuresh, thanks very much for being with us today. Appreciate you giving us all that perspective. We're down to the last minute and a half of today's trading session. And once again, it's been a session that's all about mid-caps. By the way, interesting thing, look at the mid-cap index, which is up about 0.7%. But the small-cap index is not up as much. And this is a marked difference from, let's say, February, when small-cap and micro-cap were completely, bursting through the roof. Now the buying is more concentrated in the mid-cap, the defined mid-cap universe. At least that's the trend last 2 days. Some names that really pop up. Max Healthcare is having a great end, 6.5% higher. Look at Dixon, 5%. United Breweries, the stock we were just discussing with Sudarshan, 10% higher. Cello World, 6%. Data Patterns, 6%. It's a long list. And then the PSUs, Aircon, 7%. SAIL, it's Fact, MRPL. So lots and lots of stocks, PSU and non-PSU. But a very, very vibrant, broader screen. But Prashant, I mean, large cap space, once again, slightly quiet.
Quiet, absolutely, Surabhi. So, if you just want to take a quick look at the names there, the metals, of course, the metal names, Hindalco, JSW Steel, Tata Steel, really top of the list there. Cipla, Power Grid and Kotak Bank were some of the others which participated in the upside. On the downside, I mean, you had Bajaj Auto, the insurance companies like HDFC Life, TCS down, Tech Mahindra, the other one, which was lower. And, of course, earnings reactions from Tata Consumer there, which was the top loser, actually. Tata Consumer on the Nifty was the top cut.
Okay, all right. Well, on that note, though, we'll have to wrap up on this edition of Closing Bell. You stay with us. Markets Forward comes up next.